Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
Okay, so let's dive right in. We're focusing today on WYFI Incorporated. Ticker is WYFI. And this is an equity that it really sits at a fascinating intersection of, capital market speculation and this genuine tech revolution happening in AI colocation. It's a critical one to look at right now. It was trading recently at $20.86, which gives WYFI a market cap of, somewhere between $705 and $800 million. The whole sector is getting massive attention, obviously, because of this just seemingly limitless demand for AI compute. So I think the core tension, the real disagreement here is this. Is the market getting it right? Is this valuation justified by the growth they have locked in? Or is this a dangerous disconnect from reality that's being driven by, market mechanics and some serious structural flaws? I'm arguing for the former. The market is correctly valuing the scarcity of these assets and the revenue they've already locked down.
And I just come at it from a completely different angle. I mean, look, the narrative is intoxicating. I get it. The demand for AI infrastructure is absolutely real. But the specifics here, the financial and structural mechanics of WYFI are deeply, deeply troubling to me. This company is a pure play on execution risk, plain and simple. We're initiating with a sell, a short rating actually, with a target price of $12.50. I believe this premium valuation is built on an illusion of scarcity, and it's compounded by huge operational risks and frankly weak counterparty certainty. The stock's priced for flawless performance, and that premium just can't hold up. So, to elaborate on that short thesis, the current valuation of WYFI, it demands a level of perfection that, small cap pivots like this just rarely, if ever, achieve. If you look at the numbers, the company is trading at an estimated 14.0 to 15.0 price to sales on a trailing 12-month basis. And TTMPS is a standard metric, but here it just shows how inflated things are.
Right.
To put that in context, benchmark it against a clear competitor, Applied Digital, APLD. They're in the same high-density space. APLD trades around, 8.4x TTM sales? The gap between an 8 times multiple and a 14 times multiple. It implies the market thinks WYFI will grow almost twice as fast or have insanely better margins with far less risk. And the only reason this high multiple is even holding up is because of an artificial scarcity, a really restricted public float. The tradable supply right now is tiny. It's around 9.4 million shares. And that low float means a small amount of buying can just send the price soaring. But, and this is the key, that technical floor is about to vanish. The single biggest catalyst for a collapse here is the lockup expiration on February 3rd, 2026. That event is going to make something like 27 million shares eligible for sale. That's a flood of supply, nearly 3 times the existing public float. That mechanical supply shock is going to completely alter the equilibrium. It virtually guarantees a severe valuation compression as the stock just reverts back to a more rational multiple.
Okay, I hear you on the market mechanics, I do. But I think focusing only on trailing metrics and, the technical float risks missing the forest for the trees here. You just can't value WYFI on trailing revenue. TTM is irrelevant when their whole business model just pivoted to capitalize on massive future contracted revenue in the fastest growing tech sector on the planet. That high multiple you mentioned, it reflects the undeniable value of securing early capacity in high-performance computing when power and real estate are critically scarce. So our focus has to be on the future. And the validation is right there in the $865 million 10-year contract they signed with Nscale. A deal of that sheer size provides incredible long-term revenue visibility. The market isn't valuing last year's business. It is correctly pricing in future annualized recurring revenue, ARR. That's the game.
And that low float, look, it isn't necessarily just an artificial prop. You can also read it as a strong signal. It suggests insiders, the people who really understand the value of these assets, are holding on tight because they're betting on that future value, not on short-term volatility.
I appreciate the focus on ARR, but the quality of that future revenue is paramount. I'm sorry, I just don't buy that the Nscale contract is the rock-solid anchor you're suggesting. Yes, $865 million is a huge headline number, but let's remember that's contracted value. It's contingent on N-scale success. It's not cash in the bank for white fiber today. We have to look at the counterparty risk. N-scale is a venture-backed startup. They're funding their growth with VC money and debt. That introduces significant credit risk. I mean, contrast that with a company like Iris Energy. Their anchor tenant is Microsoft, an investment-grade hyperscaler with deep, predictable pockets. White fiber's revenue security is completely tied to N-scale's ability to survive and thrive for a decade, which, is far from a given in this space.
That's a reasonable point on the credit profile, but I would frame the risk mitigation very differently. Okay, so N-scale is not Microsoft, granted, but they just secured very, very strong institutional validation. They closed a $1.1 billion Series B round led by Aker ASA. Aker is a massive Norwegian industrial holding company. They have serious financial clout. I mean, that level of institutional backing and all the due diligence that comes with it significantly de-risks any immediate chance of N-scale defaulting. We're talking about billion-dollar validation here. And beyond that, the main validation is white fiber's own sales execution. Securing a 10-year deal of this size with any tenant, especially one needing this kind of high-density power, proves white fiber can lock down anchor capacity in an incredibly tight market. The ability to close deals this big is the real measure of success right now. The market's rewarding the ability to sell that future power, not just the strength of the current tenant's balance sheet.
Okay, even if we grant the validation of the Series B, the problem just shifts from the tenant to white fiber's own execution. The operational hurdles to even start servicing that contract are immense, and it creates what we're calling the revenue air pocket in the first half of 2026. Let's unpack that. Management's own guidance says revenue from their flagship NC1 site, the one for N-scale, won't even start until May 2026. So that leaves this 4-month gap, January through April, where the company is burning a maximum amount of cash. They're spending hundreds of millions retrofitting old industrial sites for these incredibly demanding 40 to 100 kilowatt racks. And that retrofit process itself is technically perilous. It's extremely complex to get those power densities safely in an old building. And the timeline is so aggressive. Think about the supply chain. Lead times for critical things like high-voltage transformers can be 18 to 24 months. Any little slip-up pushes revenue out even further, while the cash burn just keeps going. For a stock price for perfection, at a 14x multiple, a 3-month delay could be catastrophic.
I'm not convinced by that because I think viewing it as an air pocket misunderstands how large-scale infrastructure gets built. Of course, there's upfront capital burn before monetization. That's just the cost of entry. The risk you're highlighting is, I think, substantially mitigated when you consider the strategic value of what they're building. That 96-acre North Carolina site is built on a pre-existing 99-megawatt power connection. Let's be very clear, power rights are the single most valuable, most difficult to replicate asset in this entire industry today. Getting new connections like that can take years. White fiber already has it. So the risk of some delay is cushioned by the strong potential for M&A. I mean, a private equity fund or a bigger player like Digital Realty would pay a huge premium just for the power rights and the land, even if the building's not finished. That creates a really robust asset floor that protects against the collapse just because of a short-term construction delay. The value is in the physical asset itself.
That's a strong point on the asset floor. And I agree, the 99-megawatt connection is a premium asset. But let's talk about the internal structure that's supposed to manage all this. I have to raise some serious governance concerns. We have the CEO, Sam Tabar, and the CFO, Erky Huang, holding dual roles at both White Fiber and its former parent, Bit Digital. A dual CEO and dual CFO structure just screams conflict of interest. It splits their fiduciary duties. So the core question is, where's the priority? When they're in that maximum cash burn phase next year, who do they serve first? The cash flow and crypto mining business of the parent, or the high-risk cash-burning AI retrofit of the spinoff? This entanglement, which was even flagged in their S1 filings, it raises serious red flags for me about whose financial interests are really being maximized here with every decision.
Reason for it during this phase. That structure allowed them to leverage shared resources through a transition services agreement. It was essential to streamline the IPO and let them focus on one thing, landing that massive N-scale contract, which is their lifeblood. And what's more, Look at the executive's expertise. Tabar and Huang, they have strong backgrounds in legal and capital markets. That financial engineering skill is exactly what a company like this needs right now. They need to raise hundreds of millions of dollars for a 200 megawatt build-out and navigate very complex financing. So while the tech teams handle operations, their ability to fund this rapid growth relies on the high-level financial background these executives have. The structure is really optimized for what matters most at this moment: raising capital.
The challenge remains that WYFI is floating on an artificial scarcity premium. Its 14 times price to sales multiple proves it's unsustainable and completely out of line with its peers. And that premium is going to be structurally eliminated by the February 3rd lockup expiration, which will flood the market with 27 million shares. You combine that definitive event with the precarious revenue gap until May 2026 and the fundamental risks with Nscale, the path for this stock just inevitably leads to a sharp, painful reset down toward our $12.50 target. The technical overhang is just too big to ignore.
And to summarize the bull case, the current valuation is a justifiable, if aggressive, bet on the massive, irreversible growth of AI infrastructure. That $865 million Nscale contract provides a secure, long-term revenue stream that validates the market's focus on future potential. And crucially, the underlying asset value, that 99 megawatt power capacity and the land, provides a robust asset floor that mitigates a lot of the short-term risks. The governance structure, I think, is just a necessary adaptation to finance this kind of rapid, large-scale development. You're investing in guaranteed future capacity in a critically constrained industry. That justifies the premium.
So this is clearly a case where investors have to weigh these hard, observable structural mechanics against an incredibly powerful market narrative.
Exactly. The whole thing really hinges on whether those structural risks you've highlighted, the lockup, the capital burn, cause a panic before the operational assets can actually achieve scale and start generating the revenue that contract promises. There's clearly more to explore in the material as this high-stakes story develops.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching and see you next video. Bye-bye.